All right. Good morning, everyone, and welcome to our discussion on business income tax. Uh, so, uh, Business income tax will deal with both the level 2 ICA course and level 3 ICA course. All right. So, it deals with both places. It's just that in the level 3, they are very critical in terms of application, but in the level 2, it is purely knowledge. Knowledge being that you have to go in and do the computations. All right, so that is how the level 2 is. But the level 3, you are actually asked to express your understanding and apply it in a specific circumstances. So we are going to look at business income taxation. Let me use the black. All right, so let's look at business income taxation. All right. So in terms of trying to understand how this aspect works, I'm going to go in and try to take you up from the scratch, why they are paying tax, what is the situation about the law, what does the law says and everything, right? So that is how we are going to approach it. Now, so we're going to start from section 1. So let's look at section 1 of, and our act that we are using for business income taxation is solely the Act 896. All right, so Income Tax Act 2015, Act 896. It has undergone some amendments, and I will let you know as and when we come across them. All right, so that is it. Now, so Section 1 talks about imposition of tax. Now, the tax we are talking about here is income tax. Of course, per Section 9 of the Revenue Administrative Act, tax has various meanings, all right? So our focus here is on income tax, okay? So that is that. And according to this one, it requires that people who pay tax so we are looking at those who are supposed to pay tax. So we say tax is actually payable and according to Section 1, we have 1, a person who has a chargeable income for that year of assessment. So we look at, and when the law says a person, we are looking at an entity or an individual. All right, and by entity, remember the entity variable, we are talking about what? We are talking about trust, we are talking about company, we are talking about partnership, then the individual also comes in. Okay, so that is what we are looking at. So a person or an individual having what? A chargeable income. Having a chargeable income. All right, the same act says that tax is payable by a person who also receives a final withholding tax. So we are looking at a person who receives final withholding tax. All right, so that is it. So if you are a person, a withholding tax agent, I mean, definitely you have to be paying tax. All right, so these are the things we are talking about. And please, with whatever we say, we are looking at a particular year of assessment. So within that year of assessment, that is what happens. Now, in terms of how much the person is supposed to pay, comes by the rate. All right, so rate of tax, and it's still under section 1, subsection 2. We are talking about the rate of tax. The rate of tax is actually referred to, the law refers that one to the first schedule. So if you want to know the rate of tax, you have to visit the first schedule for that. So for example, in the first schedule, we have hotels, paying income at a tax rate of what? 22%. We have manufacturing companies who are based in Accra, Tema. So let's say manufacturing company who are based in Accra, Tema, are paying something like 25%, which per the finance minister's proposed bill will increase to, I think, 30%. All right. So those are the things. Okay. But when you apply this thing on the income of the person, don't forget that you have to also treat the foreign tax. All right. You have to deduct foreign tax. Okay, so if the person or the entity has a P abroad or something, it is taxed over there. In terms of consolidating, if a person also, you are a resident, you are an individual and you bring the income in, don't forget when you are an individual, we will look at that. The source of your income doesn't matter so far as you're a resident, all right? So that is that. So in that case, if there is an entity has sourced the money from, let's say, part of it being outside the country, which is deemed resident, you still have to be taxed, all right? But herein, we will have to look at the foreign tax that has been paid. As for those in level 3, we've talked about this in our double taxation, all right? So that is that. Level 2, there is nothing like double taxation. When you grow up, come to. All right, so we will. So these ones are, like I said, discussed under double taxation. Even in the level 2, we talked about the employment income where somebody earns income abroad. So you have to bring in the gross income along with the tax that the person has paid. All right. So that is how. So we will discuss this thing about double taxation and double taxation. All right. So that is that. Now there are keywords outlined here. We have something like chargeable income. And so therefore the question is that what is a chargeable income? What is a chargeable income? Well, we have section 2 helping us to define a chargeable income. So section 2 of Act 89 says that when we talk about a chargeable income, CI, we are referring to an accessible income. So the income that is actually accessible to tax. All right. So the accessible income is sourced from, so your employment is sourced from where? Your business, and that is where we'll be concentrating on. Your business source also from your investment. All right. So that is that these are the sources. Okay. And when you get these accessible income, then the law allows you to less what? Deductible or deductions that are allowed. All right. That are allowed under the Act 896. All right. So that is what we will be looking at. And here we will be focusing on section 9 to like section 17, and we will add section 23. All right. So those are the things. There are other things into when you get to the things that we've talked about. In level 3, we talked about constraint to tax planning. So those parts that we discussed. All right. So those are that. All right. So that is accessible income. All right. So income from your employment, business, and investment. But that said, the law actually talks more into details in section 3 of Act 896 about the accessible income. All right. So let's take that one out. We are building on progressively. Let's take that one out and talk about it. So we've seen what a person who is supposed to pay tax, person who has a chargeable income. So if a business has a chargeable income, the business is actually meant to pay tax. Now, how much the business has to pay a tax depends on the rate applicable. And so that one gives reference to what we have in the first schedule of our 896. So you go there, you find out, like I said, I've given some example. And you also have to take into consideration how much foreign tax that they paid in respect of that same income that you are bringing together as the person's chargeable income, owing from its accessible income. So that is what we go through. So let's look a little detail about the accessible income, all right, so that we can get to understand what it is. All right, so talking about accessible income, what I'm going to do, so we are looking at the accessible income. Now, we will be concentrating on section 3 of the Act 896, talking about accessible income. Already we've seen that the accessible income is a composition of what? The employment income, income from employment, and also from business, and also from where? Investment. So in Ghana, these are our sources, all right? So from investment. So if you don't know where to put an income, you have 3 umbrellas to put the thing under. So these are where you source it from. However, when you continue to read subsection 2 of the section 3, it actually makes some distinction between accessible income of a resident person and accessible income of a non-resident person. Now, and so that is what we want to do. So we want to look at accessible income in terms of a resident person. All right. So and we will also look at it in terms of a non-resident person. All right. Don't forget, Ghana is now doing a hybrid of the residents and the source. All right. So if you're a citizen, your incomes that are taxable are those ones from employment, business, investment. All right. I mean, if you're a resident, those are the sources of your income, whether or not where you derive the money from has ceased or not. Okay, so it doesn't matter where you derive the money from or whether that place is still continuing or is dead, you still have to pay tax on it. So, so the resident person, the accessible income in terms of a resident person is the income from employment, which we've dealt with, then business, which we'll be looking at, and investment. All right. So for a resident person, these are your sources. And please, like the law states, is whether or not the source from which the income, so that is what the law says, for which the income is derived has what? Ceased. Okay, so it doesn't matter whether the place is still ongoing or it's not ongoing. So far as you are a resident person, then it means that you will have to add that into your accessible income. Now, the question is that if that is the case, who is then a resident person? If we want to understand a resident person, then we need to still go back to the law, okay? So the law defines a resident person in section 101 in 4 elementary stages or under 4 principles. Okay, so number 1 is about citizenship. All right, so let's say citizenship. So if you are a citizen, you are a resident, unless, so a citizen other than one, I mean, other than a citizen, who has, according to the law, who has a permanent home outside Ghana. All right, outside Ghana. And has lived in that permanent home for the whole period that we are talking about, the whole period in the year, the whole year. All right, so what year are we talking about? We are talking about the year that probably an income is relating to. All right, so the whole period of that particular year. So that is the citizenship rule. All right, so that is what you need to put into mind. So let's say we have footballers like let's look at this guy, Tariq Lamptey. All right, so Tariq Lamptey. All along, Tariq Lamptey has been a citizen of Ghana. That is why he is playing for the Black Stars. All along, I think the parents are Ghanaians, and if you have Ghanaians who give birth to a Ghanaian, by our law, citizenship can be by birth. All right, so because of that, he is a Ghanaian. All right, but you realize that Tariq Lamptey, until the point where we go to know him joining the Black Stars, has always been in playing for Brighton, and he has always been in England. And so you don't get Tariq Lamptey to pay taxes on his income that he's getting from the football he's playing for Brighton. Why? Because even though he is a citizen, what happens? He is a citizen, but he has a permanent home outside Ghana, and that is where he lived. He wasn't coming to Ghana unless immigration can give us some data. All right, so that is that. That said, I had it in mind to connect this residency concept, especially the aggregation principle, to the immigration work. So probably when I get to point 2, I'll talk about it. So far as Tariq Lamptey is not earning any money in Ghana, all his money that he's earning is in UK. All right. And even that, if we can term that in as an employment, I think we have a law around Section 112 that actually sometimes actually exempts them from those monies. All right, if the source of the money is just employment income. All right, so that is that. I think we looked at those things under employment income, where he has gained an employment outside the country. The employer is a foreigner and he's there for more than 183 days. All right, in that case, that money is exempt if that is his employment income. But let's say he's doing business, because our focus here today is business. So in this case, what we are trying to say is that unless he has a business in Ghana that is earning him money, for which it's sourced in Ghana, so we might have to tax it, then in the case of a resident person, Tariq Lamptey is not resident. All right. Yeah. So even that in a period where he comes to Ghana to play for Black Stars, which he is here, he still has a permanent home in UK, which he lives the whole of that year. Even though he comes here, he's just here for a Black Star purposes. All right. So that is that, unless he comes here for other things. So let's strike that. Okay. So a citizen, other than someone who has a permanent home outside Ghana and has lived in the permanent home for the whole of that year, is a Ghanaian, all right, and a citizen and a resident. Okay, so that is what we have to understand. So unless that person is, at this part of this statement, if you are a citizen, then you are a resident. Okay, so now the number 2 talks about the aggregation principle. All right, the aggregation principle, the aggregation principle is about the fact that we have somebody who is present in Ghana. So we say present in Ghana for a continuous period, or striking that off. It's not continuous anymore. For an aggregated period or an aggregate period of 183 days. All right, so you are in Ghana for, it's not really continuous because some people can go and come, but an aggregate period. So aggregate of what? 183 days. That basically is like 6 months. 183 days or more. All right. So if you are in Ghana for an aggregate period of 183 days or more. But watch this. The law asks this: in a 12-month period, that begins or commences, or, so the key is or, not end. It's or not end. Begins or end what? During that year. During that year. All right. So please, it has to be stricken, because sometimes people think that, okay, so according to section 18, the assessable, the year of assessment for an individual is what? The calendar year. And they will also say the basis period is also what? The calendar year. So if you take, let's say, 2022, for example, year of assessment will be 2022. The basis period, therefore, will be what? 1st January to 31st December 2022. Now, looking at that case, and people have usually misquoted the law by saying that the 12-month period that begins and end. So begins and end during that year. So it means that if the person aggregation begins in, let's say November, and it crosses into the next year, within that 12-month period of January to December, the person wasn't a resident. Come on. So the law says that beginning for a more than 183 days or more in a 12-month period that begins or, so it's not end, or ends during that year. All right, so please, it has to be straight. Now, then the third one is the government posting. All right, so if you are an employer of government of Ghana, employer or an officer of GOG, government of Ghana, who has been posted abroad, you are a resident. Even though you may be staying there for the whole year, you are a resident. All right. All right. Now, and the fourth one talks about somebody who has temporary absence. Okay, so if you are temporary absent for a period of 300, not exceeding 365 days. If you are temporary absent, then it means that, please, it doesn't really mean that you are not a resident, but you are a temporary citizen. You are a citizen, sorry, it's just that you are temporary absent. So a temporary absent citizen. All right. And the law says that if you are a temporary absent citizen for not more than 365 days. All right. So 365 days, or 365, sorry, continuous days. So this is where the continuous are. Continuous days. So the continuous is the key, 365 days. All right, continuous, 365 continuous days. All right, where that person has a permanent home, establishment or permanent home in Ghana. So you have a permanent home in Ghana. But the thing is that you just left outside the country, all right, for a temporary purposes, and you weren't there exceeding what, 365 days. So it's kind of in connection with this. All right, so that is what it is. Okay, so these are what defines residence. All right, these are what defines residence. Now, the law continues to talk about this. Don't forget the entity variable. We have partnership. So a partnership is a resident partnership, so long as a partner resided in Ghana. All right, so long as a partner resided in Ghana during that year of assessment. Okay, the year. So in that particular year, it means that that partnership is automatically what? A resident partnership. Not only that, don't forget, we also talk about trust as one of the entity variables. So there is a trust is also a resident if it is established in Ghana. Okay, all right. If it is established in Ghana. And also if a trustee of that trust has also resided in Ghana, just like the partnership in that year. So if the trustee has resided in Ghana, trustee of the trust, we've also done trust taxation. So you know who a trustee is about. So a trustee has resided anytime in Ghana, has resided in Ghana anytime in that year. So in that year, that person is also what? A resident. The trust is also a resident. And also we are talking about the management and control. So if there is somebody, a resident director of the trust, all right, whether that person is directing the thing or a senior manager, all right, let's say a manager, and not just any manager, a senior manager, all right. So if there is a senior manager, then it means that if the person is directing the trust, it doesn't, and that person is a resident, doesn't matter where he's doing it from or where the trust is, so far as that person is a resident, then it means that whether he's doing it solely, doing it via with people, the trust becomes a resident. Now, let's now come to the main deal of a company. So in terms of a company, so far as the company is registered under the Act 2019, Act 992, the company is a resident. Not only that, if in terms of the management and the control, all right, this is where it gets interesting when you are doing international taxation, trying to understand residence under Article 4. Again, so you see, we are saying that if the company is registered in Ghana under this Act 992, the company is a resident. If management and the control are also exercised in the country, during that year. So the country during that year, it means that for that year, the company was a resident. And so it gets interesting where you have a company who is registered in Ghana, but the control is outside Ghana. But this concept is an or concept. It's not and, A-N-D concept. All right, so but you see, so one will be here, the other will be here, and we use Article 4 to get where it should belong. So that we say, is it in Ghana? So let's say a company is actually not incorporated in Ghana. Let's say it's incorporated in UK, but it is managed from Ghana, controlled from Ghana. Who owns the residency? Is it UK or Ghana? So I will leave that to when you join the Chartered Institute of Taxation, you understand all these things. All right, so that is that. So these are how residents are what defined in our Act 896. So going on, I want to say something very interesting that is also in the Act, and it embodies what it's about what our law says in Section 102. All right, that one. So point one is that when a person becomes resident, either by any of these four means that we earlier stated in Section 111. So once you become resident, it doesn't matter when you become the resident, you are deemed resident in the entire year. So if you were assessed as a resident person, let's say our resident entity, let's say in November, during that full year of assessment, if your year of assessment is also the calendar year, then it means that you've been a resident during those the full year. All right, so you are deemed resident for the whole year. All right, take note of that. But there is an exception to this rule. The exception to the rule is someone who was a resident by the aggregation principle. So the aggregation principle that says that you have to be here for 183 days or more. For that one, you become resident the day your 183 starts, not ends, the day it starts. So you become resident. So from day one, you stepped in, you become resident. So it starts from day one of your 183-day count. All right. Okay, so that is that. But one thing you need to know is that so far as you become resident as at this time, so on that day you become resident, all your assets that you had, so by law, all your assets that you had will be held at what? Market value at the time of your residency state. So immediately we will measure all your assets. But hold on, subsection 6 of section 102 says that this one doesn't include your domestic assets. All right, it doesn't include your domestic assets. So this one is excluded. So we will count all your assets, all your businesses, everything. We will value them at what? Market value, the day you become this. All right. So that is that. Then on the day you become, you no more become resident. So let's say you become non-resident. On the day you become no more a resident, what happens? You will measure your assets also, because on that day you become non-resident, your assets which you have over here, on the day this state is reached, it is deemed realized. All right, deemed realized. I mean, section 38 of our 896 talks about realization. All right, so it is deemed realized, and we've done this thing. It also we've studied realization too. So on that day, the market value of that assets. So here too, it is excluded, excluding your domestic asset. So all the assets that you had over here, we will do the market value again. So, and then we will determine what gain or loss on that realization and tax it. All right. If it is a gain, we will add it to your business income and go through the taxing system. So that is what you need to know. All right. So these are the things you need to know. All right. So that said, let's talk about the real thing about our business income. So let's now discuss how we tax the business income. So how do we deal with business income? Now, the question we need to ask ourselves is that we are talking about business income, taxation. But the question we need to ask ourselves now is, what is a business? When we say a business, what is a business? Because we need to know what a business is to be able to tax it. So we are going to understand what a business is from interpretation, section 133, all right? So section 133 says that a business is a trade. It is a profession. It is a vocation, all right? Or an isolated arrangement that has a business nature. So that is what any isolated arrangement with a business nature. What is a business nature? A business nature is profit, all right? Person is in the business for making profit. Nobody is in the business for making a loss. So even if you go into a vocation and that vocation, let's say you are doing what do we call it? you are doing dressmaking, hairdresser, you are in a business, you acquire that vocation and you are doing it for profit. I mean, it's a business, so we have to tax it under business. Anyway, I'm wearing this because we won. All right. I think for those of you who think my team is dead and buried, we've started coding some clean sheets. So please give us some break. As for Madrid, let's see what happens. All right, let's move on. And we are talking about whether this thing is a past, a present, or prospective. Okay, so prospective. They are all business. But the fact is that we need to make sure we understand that this thing excludes what employment. All right, it excludes employment. Now that we know what a business is, let's now look at the income from the business. All right, and that side, we will be focusing on section 5 of Act 896. What does section 5 of Act 896? All right, so section 5 of Act 896 talks about the income being the gains and or profits. All right, so that is the income. That is the income. And is the gains and the profits. And we know that gain is what you get after selling something. All right, so let's say I have an asset, I've sold the asset, so realization will come to play. I need to determine cost and I need to determine consideration receipt. The difference is what we gain. Profit, you have to pass through the P&L concept to end at your profits. All right, so that is that. And so the standard goes on to say that in trying to determine the profit of a business or the gain of a business, we need to consider one, the service charges or service fee. All right, and that service fee, please, we are looking at the gross. What do I mean by the gross? I'm talking about without withholding tax that has been charged on the money. So if in the question, they give you sales and they tell you that, I mean, that sales is the net, you have to gross it up back. So let me give you an example. So we are talking about gross, okay? So gross of withholding tax, but this service fee should exclude VAT components like the NHIL, COVID, okay, get fund. All right, so your sales doesn't include those things. But if withholding tax, so let's say you have 10,000 net. So in the question, they say 10,000 net of, let's say, selling something which is at 3% withholding. Then it means that we need to gross this thing back by taking the 10,000 and dividing it by 0.97. Okay, so when I do that, what do I have? Let's say 10,000. So it means that the 10,000 is a representation of 97%. The 3% they did that. So if we gross it back, so what do we do? 10,000 over 0.97. So it means that the thing actually costed 10,900 309.29. So it means that the withholding tax, which is 309.29, was deducted. So this one becomes what we call it, the gross we are talking about. So this is the figure that you need. All right, that is what. Later, you now reduce the tax on this after you put in the tax payable of that business. All right. So that is that. Number 2, we will be looking at consideration received. So let's consideration received from trading stock. From trading stock. All right. So consideration received from trading stock. What is a trading stock? We will look at that later in the course. So that is IAS 2 finished goods, work in progress, materials that is used in the ordinary course of activity or traded in the ordinary course of activity. And that is what we mean by a trading stock. All right, so that is that. We will look at it more when we get to section 11, all right, when we are talking about deduction allowable, in terms of trying to understand how to get our profits, all right. Okay, so consideration received, what you get in terms of selling your inventory or what you do normally. Then we are talking also about realization gain. So realization gain. And here, the realization gain, we are going to look at it from two perspectives. We are going to look at it from the perspective of capital assets. And we are going to look at it from the perspective of what? So capital assets or liability. And also from the perspective of what? Depreciable assets. Okay, so a depreciable asset is actually an asset that reduces in value because of their wear and tear. All right, and so that is something you need to take note of. All right, so when do you have a realization gain? So here we are talking about, do you remember capital gain? So I have an asset, which is my symbol of ownership in a company. It is priced at 5. Then at some times it got to 7 where I traded it. So I had a difference of 2 as a gain. That is what we are talking about. All right, so that is that. I had a liability of 7. At the time that I am supposed to make the payment, fair value of that liability is 5. It's a gain. All right, so that is that. A depreciable asset, we are talking about those assets that you use in the production of income that is subject to wear and tear. So let's say something like your motor vehicles and things. Here I use shares. Here I'm talking about, let's say, a bond. All right, here I'm going to use like motor vehicle. All right, so when you sell it, okay, when you sell that asset, motor vehicle, section 38 realization, you determine the cost. All right, all the costs, everything. You look at the consideration that you have received, you compare the gain to it, you compare it to the cost, get your gain. All right, so you add it to your income for taxation. Then number 4, we are going to look at gifts. Any gift that you receive in connection to a business is also added to as your business income. All right, so that is that. The law actually gives, we've done gift tax, so you understand what we mean. So either you add it there, tax it during your 25%, or you can actually tax that in individually at 15%. All right, so that is that. But even that one, it is restricted to investment and I think, all right, so from the lessons we did in gift taxation, so those are. Okay, so I think employment is really added to the employment income. All right, then any consideration that you receive for some restrictions that you have allowed on yourself, or consideration for accepting some restrictions, all right, restrictions. Okay, so that is that. But in trying to determine this income, one must be aware to exclude some things. So typically, there's section 7, which people don't like to read. So, for example, income of a cocoa farmer doing a cocoa business, any income derived from that is exempt. So let's say income from cocoa by a cocoa farmer. All right, is exempt. We are talking about, look at our local government, or let's say the government of Ghana, any business of the government of Ghana. So far as those people are doing their core principles, any income they generate from that is exempt from tax. All right. But if they sway from their core principles, I mean, that one is taxed. So let's say SNET. SNET, any income that they get as part of operating that trust business is exempt from tax. However, if SNET go and establish a business like the way they've constructed buildings and they are giving it out for rent, a whole separate business on its own. If it is not in their mandate to be doing that, if they do, any income that they earn from that side is taxable. All right. So please, and in Ghana too, I think if you operate a trust or any institution that you operate, which is solely into a scientific research, which is solely into scientific research, any income from that place is also exempt. All right, so please you know that. And even from the residency rule, if the person became resident and his income is sourced from what do we call it, the ship business or aircraft business, all right, that income is also exempt from tax to the extent that individuals who are in that person's country are also exempted. So if in that country Ghanaians are not exempted, then also in this country you will not be exempted. All right. So that is that. Business income excludes employment income. You have to take note of that. And it also excludes any business on which final withholding tax has been calculated on. So if the withholding tax is final, you don't bring it back here. All right. So that is that. All right. So these are the things we need to know about the income side. So you see, what we are trying to do is that in trying to determine our profit, the revenue side. All right. These are the things that we are talking about. All these things that we are talking. That is how you determine the revenue of the business. All right. Now, from there, you less cost of sales and you get your gross profit, you less your further expenses, you get your profit before tax, which we are going to tax. And so my next thing that I'm going to do now is going to look at the deductions, all right? The things that you're allowed to deduct from your profit. All right, so let's look at those things. Okay, give me a minute. All right. So I had to go and answer a tax question, which I think will be of interest. So when we get there, I'll mention it out to you. Probably something you should watch out from your exams. All right, so that is that. So now let's look at the deductions that you are allowed to deduct as part of your expenses so that you end up at your profit. So deductions allowed. And out of the allowed, you will see the disallowed ones, all right? So that is that. I'm going to start with the residual deduction rule, which is section 9 of Act 896. It's called the residual deduction rule. So when you see in your exams residual deduction rule, don't be afraid. So the residual deduction rule operates on the when principle. You can also call it the NEU, new principle. It is actually saying that expenses are only allowed to be deducted from your profit only when it is wholly. And when we say wholly, we are talking about quantum. All right. It is wholly an amount that is spent for the purpose of generating income for the business. All right. So what we are trying to say is that, so if the income you've spent or the expenses that you've made is not wholly to the purpose of generating income for the business, then it means that you have to split it. All right, so that is what it is saying. So the total amount, quantum here, we are saying that the total amount should be for generating income for the business. All right, because if you don't spend that money, you'll not be able to. So therefore, there has to be a split if there is a domestic aspect of it and business aspect of it, so that only the business aspect is allowed, then the domestic aspect is not allowed. All right, so that is that. That is that. Okay, let me just take a pause and still respond to these people again now. This withholding tax issue on fuel is an issue on my tax platform now. People are discussing. If you go to buy fuel at the filling station, are you supposed to withhold tax? Okay. According to the law, we will get to that when we probably deal with section 11, which talks about trading stock. So we will get to that. So the point is that the law says that if a trading stock, something is a trading stock in the hands of the wholesaler and the retailer, it is not with, the tax is not withheld on it. So for example, if let's say Total buys fuel from BDC like Petroleum Warehousing, Total cannot withhold tax on that thing that they bought because it's a trading stock in the hands of the wholesaler and the hands of in the hands of the BDC. All right, and over here, so somebody is asking. I think the only way that a business will not pay tax is that when the business does that, the business is going to the filling station, not so it is the car driver who is going there to load. But if an entity, so in the supply chain, the entity and the OMC, the entity is not also going to sell the fuel, it is going to use the fuel. So the question has been whether withholding tax should be exempt or not on that. So far as it's a trading stock between the wholesaler and the retailer, I mean, tax is exempt. But as for the business is not trading that same thing. Probably is going to use it. So withholding tax applies so far as the business is a withholding tax agent. All right, so that is how it is. So I'll have to give another comment on that very soon. All right, so let me attend to them. Just give me 2 minutes. Let me attend to them and I'll be back with you guys. All right, I think I've taken my time to deal with it already. So finally, the conclusion that I could give them is that if you buy a fuel at a filling station, at the time that you are buying the fuel, you have already paid all the taxes that are. All right, so the taxes are sourced. You don't need to withhold tax on something that you have paid for. All right, so the taxes that you pay on the fuel is final, right? So so let me yeah, so that is that. Okay, so let's continue with our study. We come to what exclusively. So exclusively, what are we talking about? We are talking about the fact that it's business purpose only. All right, it's business purpose only. So if there is any other purpose aside business, you split it. All right. Necessary means the thing is what relevant to generating income. All right. So if you don't spend the money, you can't generate your income. So that is that. All right, but it has to be noted that under subsection 2 of section 9, what the law says is that capital expenditure, we know capital expenditure, right? Expenditure whose benefits exceed 12 months, those ones are what is allowed for tax purposes. So what it means is that if you have a question where they put the business income inside as the capital expenditure as part of the expenses, because you claim capital allowance on those things, you have to add it back to the profit. Okay, so it is disallowed. All right, so that is that. Then the next expenditure that is allowed is section 10, which talks about interest on debt obligation. All right, so interest on debt obligation. What does the law say about interest on debt obligation? So with interest on debt obligation, the law stand is very, very clear. The thing is that the debt obligation here, this debt obligation must have arisen because you took the debt to produce income. All right, so you took the debt as part of your production activity to produce income. So we are saying that the debt is used in the production of what? Of an income. All right. So if it is there, then it means that if the debt is borrowed for the sole purpose of production of an income, then any interest that arises from that is what is allowed for tax purposes. Or in a way we describe as this used in the production of an income is that you use the money to buy an asset, all right? And that asset was used to produce an income. So that is the case then. Okay, you are allowed. All right, so maybe not asset, but it may be any other case. But whichever the case may be, it must be to the production of an income. All right, so that is that. Then we come to section 11, which talks about what? Trading stock. Here, please, here the focus is actually on what? Closing stock computation. You know, in your P&L, you less closing stock, right? So that is that. And here, how do you determine your closing stock? The law gives so you have opening stock, and in opening stock, we are saying that just any other thing that you intend to bring in the thing into its useful state, you have those opening stock. So you have opening value of your stock. You add all those expenses that you have included as part of your, what do you call it? Your purchases. Okay, so opening stock, add purchases, carriages. All right, then you come to your closing stock. Okay, so once you deduct that, so that is where then when you less your closing stock, you are now getting your cost of sales. Now, the closing stock goes by IAS. All right. Okay, IAS2. Lower of cost and what? Net realizable value. All right. And the cost aspect, we know the net realizable value is fair value less cost to sell, right? So our law actually understands the IAS2. But the cost, how you determine your cost is not like the way we determine. So the cost here, we use absorption costing. All right, that is section 41 of Part 896. So absorption costing. Now, what that means is that you get your direct material, you get your direct labor, and the overheads. We are talking about what? Production overheads. All right, so you absorb it. All right, so that is how our law sees your cost. So the lower of the two. Now, whichever one you pay, it means you have to reset your opening stock for the new year of assessment according to this one. All right, so I mean, that is that. That is that. So your opening stock would be that of last year, all right, reset according to section 11. All right, so the closing stock that is allowed is this one. The cost come by way of absorption costing, then lower of cost net realizable value. So the cost is the cost at the end of the year, lower of cost and net realizable value. Is how much the thing will price in the market at the end of the year, the market value of the thing at the end of the year. All right, so that is that. So let's come to section 12. What is section 12 about? Repairs and maintenance. And over here, the repairs and maintenance, like I actually discussed with you how you do your capital allowance. All right. So in terms of capital, so the repairs will not exceed 5%, all right, of the written down value of the pool. So the repairs will not exceed 5%. So if you have an expense, let's say repairs in your question, let's say maintenance, let's say 10,000. All right. And you have the written down value, which you will see after your capital allowance of that asset being, let's say, how much should I use? Let me use 50,000. Okay, so if you see this immediately in the question, please, what you do is that add it back to the profit. Then what you're actually going to deduct is what? 5% of 50,000. All right, so where is my calculator? 5% of 50,000. It's actually giving me 2,500. All right, so when you add this all back, the one that you recognize as a proper expense will be the 2,500. All right, so add everything back, then recognize it. You see that if that is the case, the excess between this one and this one, which is 7,500, is added back as an addition for your capital allowance computation. All right, so that is that. So it's not like you've lost the whole 7,500 just because 2,500 is here. All right, so that is that. Let me share let's use the practice note to answer some things to get more understanding on the repairs and maintenance. Okay, so let's use this to understand more about the repairs and maintenance. So this is the Commissioner General's practice note on repairs and improvement of a depreciable asset. So that is what we're going to use just to throw more light on that. I think we've dealt with this, so I'm going to go straight to the general deduction rule is what? The general deduction rule is section 8. The residual deduction rule is section 9. All right, so that is that. The general deduction rule is that domestic expenditures are not allowed as deduction. All right, so that is that. Then the residual deduction is the when principle. All right, so that is that. So section 12, this is where you have. Okay, so according to this, it says that the Act provides specific rules for deduction relating to repairs and maintenance, which stipulates that an expense should be incurred as repairs and maintenance of a depreciable asset. In the first place, it should be wholly, exclusively, and necessary the maintenance herein we are talking about. And the maintenance too should not should not be of a capital nature. All right, so that is that. So if the maintenance is a capital nature, then it is purely a capital allowance stuff. All right. Okay, so rules of deduction is what we have just discussed with you. You shall not exceed 5% of the written down value of that pool. All right, so let's look at if they have. So identify the pool of the assets, determine the 5%, all right, all these things. So the excess is capitalized, like I showed you, as you add it back to as the addition in terms of your capital allowance computation. Now let's look at some examples and we can move on. So Mauko incurred expense, and this is the expense for repairs and improvement of plant and equipment, and declared a profit of what? 100,000 this year. The written down value of the pool is what? 60,000. So here, what do you do in terms of determining the immediately this 2,500 should be added back to the profit, and you do 5% on this to determine it. All right, so that is that. So you see, this is your profit. You add it back, you get your assessable income. You do 5% of this, which is 3,000. We cannot allow all the 3,000. Okay, so we can only allow to what? You see this. If we allow 3,000, we are allowing you an excess of what? An excess of your 2,500. So we will just allow up to what? This. So in essence, we are just accepting that the expense you deducted to land at your profit of this is okay. So you see here, it is taken out and you come back to your main profit, which by way we are accepting that, okay, repairs and improvement now deducted and now over 100 is acceptable. All right. Okay, so this is that. But let's look at another way. So here you see the 2,500 on the repairs of is less than the 5%. So everything is affected. Let's look at the other way around. Now over here it is what? 6,500, the same thing. So you add the 6,500 back, or is it 6,000 or 6,500? Repairs and improvement is 6,500. So I think there is a typo error there. And these are the things that when you see, we have to draw the Commissioner General's attention to the fact that this your practice note is a law, and some of these things has to be taken care of. I saw the one on COVID. I prompted the Assistant Commissioner General. I think this is the first time I'm seeing this. Probably it should be prompted. All right. So that is on the assumption that this figure here is 6,000, not 6,500. Please take note of that. All right. So in that case, you add the 6,000 back. You see, when we had 3,000, it is you actually allow the deduction for just 3,000, and this is what we have. So the question is, he keeps making that mistake because even here the difference that he has done is 3,500. So there is something wrong out there. So what I'm just trying to show is that the 3,000, the difference will be added back as an addition in the applicable pool for computing additional capital. I think I've made this ones clear in class already. So that is that about what repairs and improvement, section 12. All right, so that is that. Okay, so now let's move on to the next deductible expense, which will be section 13. Section 13. So section 13 talks about research and development expense, R&D. Research and development expense. All right, R&D. So R&D, the laws, what is the law stance on R&D? Okay, so if you have let's say an expense that is about R&D, what the law actually says is that first of all, you have to define what R&D is about. What is R&D about? R&D is additions to business products and processes. All right, but it actually excludes R&D expense used to purchase the assets, the depreciable assets, which you are using to do the research. All right, because if it is an asset, then capital allowance applies. All right, so you have what you need to do is that you treat it on capital allowance. So if it is about research and development, but it's an asset that you bought to promote that, then what is going to happen is that you're going to enjoy capital allowance of the asset. Therefore, it will not be allowed for the purpose of research and development. Okay, but so far as the thing is R&D and it is not about this, whether or not the thing is a capital expenditure or revenue expenditure, it doesn't matter. It is allowed, all right? It is allowed. Only that if it is for the acquisition of an asset, in terms of doing the R&D, that one is disallowed because of capital allowance you get. But if the whole idea is just on S&D directly, R&D directly, whether or not it's a capital nature or revenue nature, it is allowed, all right? So please take note of that. All right. So please make sure that if this is the case, you exclude it as an expense, you add back. All right. So may I say that in terms of, in respect of mineral and petroleum, any R&D that you do for minerals and petroleum, that one is disallowed. All right. In the petroleum, so please take note of that. In the petroleum sector, it is disallowed. All right. Because in petroleum sector, those R&Ds will form as part of your capital allowance that you get. Because before production, all right, the research and development are grouped for capital allowance purposes. So please, over there, the research is actually disallowed as an expense and it is added to your cost for computation of capital allowance. So please take note of that. Then, so here is talking about section 13. Then we have section 14, which talks about capital allowance itself. All right. So we've dealt with capital allowance, only that I need to tell you that the asset should be owned and used for production of an income. And capital allowance is treated, you need to visit the third schedule for the pooling system. We've dealt extensively on that. And another key point is that capital allowance is not transferable. What do I mean by that? So let's say in 2021, we had capital allowance of 10,000. You are saying, oh, you won't claim it this year. Please give it to me in my 2022 account. Please, it is not allowed. So you claim it in this same year. All right. So please, it's either you take it or assume. All right. So please take note of that. Then we have section 15 that talks about losses on realization of what assets and liabilities. Okay, so what I'm going to do is that I'm going to split the asset. Let me say assets over here. And I'm going to deal with the liabilities over here. So what it means is that if you have an asset you sold or you realized and you've made a loss on that, or at what extent is that loss allowed as a deductible expense? Only that the assets we are talking about here, number one, must be what? A capital asset. All right, so please note that it's capital asset only. Oh, sorry. Wow. So it should be capital asset only. And we know capital assets, right? The shares that we are talking about. All right. And if you sold your shares and you made loss, and the capital asset, the purpose of the sale is just for you to produce an income. All right. So production of an income. So if that is the case, then it means any loss that you realize on that, all right, is allowed as a deductible. Please make sure you understand that it is what capital asset only. What about depreciable assets? Do you remember will be added to a pool already in the first place? And therefore, if you sell and you make a loss, the loss is granted as an additional capital allowance. All right. So that thing is dealt with under here. All right. So that is that. So here we are talking about capital assets only. All right. So please take note of that. So if that capital asset, to the extent that capital asset was used in the production of an income, if there is any realization on it and it's a loss, it is allowed as a deduction. The same way about the liability. Well, let's say you took a loan, all right, and that loan was used in the production of an income, okay, and herein where you are going to what is going to happen is that let's say let me not say you took a loan. Let me talk about bonds. You issued bond. Okay, so you issue a bond, you've created a liability. All right. Okay, so when that thing happens, and this bond is solely for the purpose of what? Generating an income, production. Like we said in section 10, you took the money for production. Then it means that if the loan, is issued at a discount, meaning that you received low money, but you are going to pay money. What is going to happen is that you have suffered a discount of a loss to get it, and therefore it will be allowed as a deduction. Okay, so please take note of that. All right, so that is that. So that is section 15 for you, capital assets and also a liability. So please take note of that. The next one is actually section 16, which is limitation on finance cost. So what I'm going to do is that I'm going to use the CJ's practice note and also section 17, which is about what carryover losses, unrelieved losses. Okay, so losses, I'll also use the CJ's practice note and also section 23, bad debt. So I'll use the CJ's practice note for this. But please, in your exams, be mindful of things like penalties. These penalties are disallowed. We cannot allow you an expense for your own indiscipline. Penalties are disallowed. So you add them back. When I say disallow, it means add it back to your profits. Taxes for previous years. You see, what people do is that the tax that they paid for, let's say 2021, in 2022, they will treat it as an expense. Please, that one too is disallowed. All right, so please take note of that. So what we are going to do is that we are going to use the practice note to deal with these things. And basically, we are done with what? Business income. All right, so what we may have to do is to pick up a past question and see how we deal with it. As for you in level 3, what they will be asking you are these critical areas. Your views on that. So, those are one. So let me share the practice notes for the first one, which is limitation on finance cost. So we've dealt with so these people are still dealing with they are still dealing with the withholding tax thing. All right. So let's move on. So this is the Commissioner General's practice notes, trying to educate us about how finance cost is done. So this is what you have. Okay, so we are trying to look at section 16. All right, so that is what we have, section 16, trying to set out some interpretation of it. And the act is still at 896. All right, so it's a 14-page document. So this is the practicality of the law. All right, so let's now digest it. Okay, so the act provides the following. The quantum of finance cost that can be deducted, that is deductible, is limited to what? The sum of finance gain. But here we are talking about the application of derivatives, all right? So finance gain derived in that year, and what? 50% of the adjusted chargeable income. When we say the adjusted chargeable income, what do we mean? Okay, so this is it. So the adjusted chargeable income is the income from business. So since we are dealing with business or investment, without including what? The finance what? Gain derived by the person, or deducting what? The finance cost. So that is that. Is this. All right, so that is where we are now. So is that adjusted income excluding what? Finance gain and what? Finance cost. So that is what we have now. All right, so we will adjust our income, chargeable income. And how do we do that? By adding back what we need to add and taking off what we need to take off. All right, so once you get to that stage, then you work out your finance limitation on finance cost, which is what? The finance gain that you have. So it will be finance gain plus 50% of the adjusted or chargeable income. All right, so that is that. So that will be the finance cost, all right, that you are supposed to. All right, so let's make progress. We will look at some numbers very soon. Okay, so here you see that finance cost has not been allowed as a deduction in the year of assessment as a result of our limitation in I. All right, so maybe carry forward for the next 5 years. I will explain that. So what you see here is that the finance cost that has not been allowed as a deduction in the year of assessment has, because of the limitation. So maybe you had plenty finance costs. Let's say after computing your the finance cost in your P&L is, let's say, 50,000. But after doing the finance gain plus 50% of your adjusted CI, you landed at what? 40,000. So the part that has not been allowed, which is the 10,000, what do? It will be carried forward for the next 5 years of process. All right, take note of that. So that is that. All right, then you also have here that it says that the finance costs are carried forward shall apply in order as when they occur. So it means that, let's say in 2020, we will explain all these things. So 2022, and we are in 2023. Let's say this 10,000 was in 2021, and you have another one also in 2022, which is what? Let's say 20,000. And over here, you need to offset, bring them in. This one will go first, all right, in order that they appear. This one will go first, this one will go second. All right, so please take note of that. We will have the numbers to explain them more. All right, for you. Okay, so how do you now do all these things in terms of getting the 50%? So you see your net profit, there's the business income thing we've been doing. You add back all those disallowable deductions, all right, then you get this, then you less the allowable ones, you get your adjusted book profit, all right. And you take off your capital allowance, then you get your chargeable income, all right. So now over here, what do you do? It is after this chargeable income, you bring in your finance costs, which by now you know how to go about it. The finance gain, all right. So this is what they've done. The finance cost in the question that has been given to you will be added back, all right. Then you take off your finance gain, all right. So then you land at this, you take 50% of this, then you add a finance gain to it, get what your allowable one finance cost. Let's see how the computation looks like. All right, so let's see. So you have your first illustration here. So the first illustration is talking about where your finance gain that you have is more than the 50% plus of the chargeable. So in this example, you see this man having a profit of this, and the following were included in arriving at this profit: depreciation, which we have to add back; Section 23, general bad debt, which we have to add back; realized loss. If this realized loss is about a finance asset, we have to keep it like that. It's allowed. All right. Capital allowance is allowed. Then once we have adjusted that, we will bring in what? We will add back our finance cost and less our finance gain. Then we get our adjusted, with which we will take 50% and add back the finance gain. All right. So this is what they've done. What are the things they add back? Cost depreciation. All right. Capital general bad debt. All right. Then which are the things that were allowed? This is it. Capital allowance to you take off. All right. What do? You add back, you less the finance. So this is where we land. Then you do 50% of this. So as you can see, 50% of this. Then you add what? The 7,000 to it. So this is what you get. Now, this money that you have obtained, you have to compare it to that which they actually used in landing at their net profit, which was this. So it means it is less than. All right. So it means this is the money that we will allow. But the question is, what happens to the difference? That is why I say it will be moved for the next 5 years. All right. So as you can see, the excess between this one and this carry over for the next 5 years. So easy peasy. That is that. All right. Let's look at a different case. So you have this, you add back. So after that, once you know this thing is just like repeating what you've done all over again. So it means that the finance costs, all right, you add back all the 50,000. Now we are doing the profit and loss proper to determine the tax. So we add back everything, the 50,000. Now that we know that the part that we are supposed to less is what? This part, then we less our capital allowance. So please, after you've gotten the finance cost, you repeat the thing all over again. All right. So that is what computation of the chargeable income. But now you know the part that is allowed. So you disallow the 50,000, then you allow what? The 36. All right. So over here, this is what you get so that you can be able to tax them. Let's look at the illustration 2. Okay, so the same illustration, what happens is that we have 22, depreciation will be added back, right? Then I always have challenges with these kind of questions, okay? Because for example, you see, bad debt is also supposed to be added back. But they told us that the following figures were included in arriving at the net profit before tax, which means that this loss was also deducted. So why are we deducting it again? Sometimes the phrasing of these things are all right. So if they actually deducted it before landing at their profit, why are we deducting it again? Because it's something that they should deduct and they did it anyway. So that is fine. We don't have a problem about that. So capital allowance, for example, is something they are supposed to deduct. So if the question is telling us that they did that before arriving at the net profit, then why are we deducting it again? Because they were meant for deduction. But in your exams, I mean, you won't get it like this. So we are assuming that that is that. And I think these practice notes, sometimes care has to be taken. All right. Because if you tell us that the following were included in arriving at the net profit, yes, this thing is something they should deduct. So they deducted it before arriving, so it's fine. So bad debt also, they deducted it, which they shouldn't have. That is why we are adding back. Depreciation, which they shouldn't have. That is why we are adding back. But for the spirit of the question, I mean, capital allowance, unless the entity computed their own capital allowance, which we, the GRA, will have to do something, right? Then that's fine. All right. So sometimes the way they code these things, but that is not the reason why we are doing this. I mean, the reason is about our finance cost, all right? So once we've added back these two things and we've less these two things that we need to less, we add back 5,000 and less what? Capital gain, all right? Just to find out the finance cost. All right, so once you do that, this is where you land. This is it. So you do 50% of this plus the gain. So what will you get? Don't forget this thing is 5,000. So what happens? We are now having what? 15,000. So it means that the finance cost that they did was 5,000, which is less than the 50%. So we go ahead and make the 5,000 deductible. No more adjustment to be done on any difference. All right. So you just allow all these ones. So you repeat your financial statements again. All right. So over here, then you less what 5,000 as part of your finance cost. So if they did that, so you could see like what I'm talking about. If they did that before arriving at this, like you've seen here, there is no adjustment to be made because they actually took off the 5,000 before arriving at what the profit. You see, we are not lessening it again. The main reason why we keep everything as it is, we move on. The main reason why I was also saying that unless these things are new figures, because what you realize is that these things are coming from capital assets only, and this is capital allowance you have to do for yourself. So you see, we don't do any adjustment there. We accept what they did. So my point, the same thing. Why didn't we accept what they did in terms of the loss? All right. So please, that is that. So where the company recorded finance cost without finance gain is another illustration that we need to look at. Okay. So all that we've been looking, the finance cost and the finance gain were recorded. So we had to work those things back. So you have to go around the same procedure. All right. So we determine what do you call it? The finance gain and stuff. So the first thing you need to do is that you see over here, what we've done is the same thing, same thing. All right. Then finance cost, you add it back. Finance gain, nothing. So there was no actually a gain to match it. Okay, so 50%, this is it, then 0. So it means this is what we have. In that case, there was no finance gain. What then happens? Okay, so watch this. Only this money, because the thing was like 50,000, all right? So only this money is what we have now. Okay. So when it gets to petroleum, everything changes. Okay. But here we are doing something different. Okay. So you realize that this is the difference is 16,500. All right. Which we all know it will be carried over for the next 5 years. But when you come here, so what you realize is that you add back your 50,000, then the ones that you allow is this part. Okay, so I mean that is what you do. Okay. Finance gain is nil and there is no positive chargeable income. Positive chargeable income, excluding what? So that is a different scenario. So that one would mean that there will be no what? Finance deduction. There will be no deduction because there is no finance gain and there is no positive chargeable income when you exclude it. So over here, the same thing, all right, there is no finance gain, but the other one, there was a positive income. But here, when you do the adjustments, what do? You get what? Zero, a negative. So if it is negative, what do you do? This is what should be what you are looking at without finance gain. So from the situation, finance gain is nil and there is negative what? In this view, there is no deduction for what? Finance cost because 50% is negative, negative, negative. And there is no gain to make it positive. If there was a gain to make it positive, then it means that if there was a gain to make it positive, fine. So it means the whole of the 50,000 may be carried over for the next 5 years. Please understand the situations we are looking at here. All right, so that is that. That is that. So in terms of preparing the new finance statement, what do you add back? Because there is no finance gain. And the chargeable income adjusted is negative. All right, negative. Okay, so that is that. All right, that is that. So that ends what we need to do under finance cost. All right, so that is that ends. So the situation is that 50% plus the adjusted. If what you had was less, then it means that you add back what you had in your finance statement, then you allow the less as allowable. The difference will be carried over for the next 5 years. If you had more, then what is going to happen? No adjustment whatsoever is going to happen in the financial statement. Everything moves. If you have a nil finance gain and you do 50% but you have positive chargeable, adjusted chargeable income, you go ahead and treat what you have as the allowable and disallow the cost that was in the financial statement. If the chargeable income that has been adjusted is negative, then all the finance costs will be disallowed, roll over for the next year for any deduction allowable. All right, so that is that. Let's look at section 17. Section 17. So this is the one for section 17. We are going to go through that. That one is pretty short, even shorter than the finance cost. We will look at losses from investment of our main this time will be investment. We talk about the period of carryover losses, which priority sector will be 5 years, non-priority sector will be 3 years. I will have to educate you about the priority sectors. Then we talk about segmentation. The priority sectors, we are going to use the LI. So I'll call them out for you. Okay. So we are looking at section 17. So this is that. All right, take a look at this. All right. I believe. So what we are looking at is uh, the unrelieved losses, carryover losses, some people call it. We are talking about the carry forward losses. So if you are in business and you made a loss from business and investment, in ascertainment of your income, so we have the priority sector, you can roll it over for 5 years. If you are not in the priority sector, then you can roll it over for only 3 years. Now, the question that we need to ask ourselves are those who are in the priority sector. So who are those in the priority sector? We are talking about the M&M, mineral and mining, Modigliani and Miller. So minerals and mining, we are talking about, there are about 7. We are talking about those also in the petroleum. We are talking also about those in energy and power. Energy and power. We are also talking about those in manufacturing business. Somebody is waiting if his sector will be part. Which one do you think? Farming. Which one again? Agro processing. Yes. Tourism. ICT business. So these are the priority. These are where Ghana looks and think that is our priority sector. So we have 1, 2, 3, 4, 5, 6, 7, 8. All right. So those are our priority sectors. So if you are doing a normal trading business, please, you are in a non-priority sector. You can roll it over for what? 3 years. Okay. So that is something we need to take note of. All right. And don't forget, in all these things are defined. So let's say if you are in the energy means that the business that is engaged in the power of what? Generating power. So electricity for, all right. So those are the one that we are talking about. So probably solar and all those things. All right. So that is that. And information technology, we are talking about software development. So ICT, here we are talking about software development. Okay, so please take note of that. MTN for near software development. Tourism, we are talking about those operators of tourism enterprises that are registered under the Tourism Act 817. Yeah, Tourism Act in 2011, Tourism Act 817. They have a section, I think it's section 25 to section 27 of the Act 817. Wow, man has learned something before. All right. So those are the things. Okay. So I mean, these are the priority sectors. All right. So what else? So if your question is given and it's not within these 8 priority sector, please, we know agro processing, right? Those who are converting the cocoa product, agro product as raw material to develop fertilizers. All right, so that is that. Let's make progress. Also, you have an illustration. So in this illustration, ABC Mining started operation in what, 2016. In the first year, they made a loss. All right. And please, let me say this before. So let me do this. because this thing happened in my exams when I was doing my CIT. So let's say you have 2017, 18, 19, 20, 21. Let's say you made a loss of 2,000, loss of 1,000, loss of 500, loss of, let's say, let me make it 1,000 again. So in 2022, we now made a big profit of, let's say, 10,000. Okay, so in terms of applying the loss, the finance cost was applicable, like this one will be 1, 2, 3, 4 in the year, like in accordance. But in terms of carried over losses, we apply it like this. This one will be 1, first, second, third, fourth. So I will reduce this one, reduce this one, reduce this one before we reduce this one. So that is how it goes. All right. So please be careful. You don't start with this one. You don't say, okay, when I may make you loss na chenti, me for 10,000, I'm about 2,000 if you know. It goes like this. All right. So you start deducting this year's own first. All right. So it depends whether if it is non-priority sector, which is 3 years, it means this part will not be included. You will do up to this part for now. All right. So that is how it will be. All right, so please take note of that. That is how the deduction happens. All right, so this is it. 2016 is the year they made the loss. Determine the number of years. Okay, so it's a mining company, so this one is priority, so 5 years. All right, so we move. So XYZ is a retailing business. That is 3 years. All right, we move. And this is the question. AB Limited has been in operation this year and declared losses. So these are all losses up to 2022. How do you apply them in 2023? So you start from here, 500. So this is how you apply it. Okay, so I think, so this one, for example, you have 500 plus 1,000. The profit is 800,000. You have much. So 1,000 plus 150,000. We still have much. All right, plus 50,000. So that is how we make progress. That is 2-1. Then plus what? 300,000. So that is how you move. Then plus 100,000. So you move from this year going, not from this year coming. You move from here going. All right. So let's see what the Commissioner General thinks. First of all, we need to understand which industry is in, priority or non-priority. ABC started business. I mean, we don't know whether it's a priority or not. So if it is priority, you start 1, 2, 3, 4, end it here. If it is not priority, you end it. All right, so that is that. So, I mean, this is what you have. So priority sector, that is, please be mindful. The fact that it started from 2018, you be very, very careful. So it goes like this. It's because the money is within the 5 years. But you start counting, because if, let's say, this loss was 800,000, 2022, and this loss is 300,000, you start from this loss immediately. All right, so please, that is how. So the previous 5 years. So if the company is non-priority, so like I said, forget about the way the thing is appearing here. All right, so you start like that. Please be careful. All right, so segmentation. I mean, this is where there is a loss, okay, but there are two businesses which have different tax rates applied to them. So here we have where a person makes loss, and if the loss were profit, have paid tax at a lower or reduced tax rate. The loss may be, it says that the loss may be deducted in accordance with the income that is taxed at the same what discount reduced rate. So please let's use the figures to understand this. So where a business operates in segmentation, where there is a different tax rates. So let's say in a business, there is a hotel and there's which is 22%. There is something else which is, let's say, 25%, different tax rate. Okay, so that is what we are talking about. All right. So losses attributed to the segment with a particular tax rate can be deducted from one income tax at the same rate. We will use the figures for you to understand. And again, where a business is segmented but the income are not segmented, there may be the need for apportionment of income of the businesses. The basis of apportionment will be the contribution of each business line to its turnover of business. So let's look at this. We have XYZ Limited, which deals with non-traditional exports, all right, as well as local sales. So these are two things, different things, which have different rates. I'm going to ask you, so as for the level 2, I think you may not have an idea, but for the level 3, it will be reasonable for you to know. I just had the message that, I mean, terminal, you're not telling us that we have a class at 1:30. I need to hurry up and set off. That's the thing. All right. So non-traditional exports, we know that local sales are different, 25. These ones will be like 8%. Okay, so so the turnover, export sales, a percentage and a local sales and so the and one. So you have losses on 200 from the export sales, traditional exports, and you have 800 loss. So under normal circumstance, what we are saying is that these losses should be matched, right? So the accessible income declared for the year for the non-traditional exports, 2017. So here you are seeing these things for 2016, then 2017, they made the losses. They made the profit. Okay, but in 2016, there were losses. Now we are to determine the unrelieved loss for 2016. How the unrelieved losses in 2016 will be dealt with. So you group the thing all together. So you see, traditional, non-traditional is 8%. This one is purely 25. This one, level 3, I think you need to know. When we were doing the tax plan, we talked about free zone. All right. So in 2016, these were the losses. Okay, that is what you have. And in 2017, these were the profits. So in a normal circumstance, you see that your unrelieved losses is this. So you match it, and this one will be 8%. This one will be 1%, because the percentages differ. All right. So every part will have its own. So together you combine them. The percentages differ. All right. So you do every part and its own. Okay. So what if you have deductions from business and investment? Is offsetting allowed? Yes, offsetting is allowed. How does the offsetting happen? So let's say you have a business and investment. An unrelieved loss from business may be deducted, all right, in calculating income from what? Investment. However, unrelieved loss from investment shall not be deducted, shall only be deducted in calculating that of investment. So investment is for investment, but business can also be for investment. So that is what we are saying. Investment cannot be for business. Investment can only be for investment. But business can be for investment. All right, so that is what we are saying. So let's look at this. So you see here, this person, 2017, they made profit, but here is a loss. Investment can only go for investment, but this year, this one can go for this profit. All right, so that is all. So you see over here that in 2017 year of assessment, investment loss cannot be offset against business. It can't. All right, so investment is for investment. But in 2018, where there was a loss of business, 50,000, investment of, you see, in 2018, what do you see? There was it. So this 50,000 will be offsetted in 2018 for this one, right? Then 2018, now you can still match the 40,000 against it. So business can be for investment. Investment cannot be for business. All right, so that is what we are saying. So you see, year of as a business loss of 2018 can be deducted also from the investment income. All right, so that is what we are trying to say. All right, so I mean, that is that. That is that. Last but not least, losses relating to income tax at reduced rate or exempt or exempt income. So in that case, you have losses from activities that are exempt from tax, or from income that are taxed at a reduced rates. What you see is that those ones cannot be deducted from profit from other businesses. So here we call it ring fencing, but ring fencing does not apply to investment. So business loss can be offset against investment income. So yawa diase, yaw eduse, or yeah, so I think it's yaw eduse company limited declared loss for 2016, and the loss was made up of transport operations and hotel operations. Now the company has declared profit in 2017. So how do we do the loss? So so you realize that you take the transport company and you take the hotel operation. So in this year, this is what they made. The unrelieved losses from 2016 is here. The unrelieved losses is also here. So what you see is that you can't allow all these unrelieved losses at once. You can just allow for 100,000. Are you getting it? So that is that. And here, because it's within, you can allow everything. So the remaining unrelieved losses, which is 150, here you have nothing, so tax rate will be nil. And here you have 570, tax rate is 22%. So what we are trying to say is that because these two rates are not the same, you cannot bring this one to affect this one, even though they are both a business. All right, it's not like investment, and they are both business, but because of differing tax rates, you cannot bring this one into this business because they have different tax rates. So you continue to carry over this one. All right, please. So that is that. So that is that for you. Okay. So what I'll end is the transitional provision. Before this act came into being, companies which were going to carry over the losses at this era, the losses that will continue with the dispensation up to the end of the basis period, which this provision applies. So please, that is the law under this one. Lastly, I just want to talk about bad debts. Bad debts. All you should know is that bad debts, the general one is disallowed, specific ones are allowed, but bad debt don't just happen. Individuals don't declare bad debt. It is companies who declare what bad debt. So companies are the ones that actually. So what happens if people wants to make provision for bad debt? So that is what this practice note is about. That is section 23 of the Act. All right, so that is where we are looking at, section 23. So bad debt for business other than a banking business, it's only allowed if the person has made reasonable steps to pursue the debt. You have to prove it. You have to prove it. So it says that section 23 provides that a person shall not be allowed a deduction or a bad debt claim as bad debt unless the Commissioner General is satisfied that you took the necessary step. What is the necessary step? I mean, you went, you did everything you could do. You took him even to court, all right, to collect your money, and the court probably declared it bad. And a bad debt claim or entitlement cannot be satisfied, all right. So if they take you to court and the court do liquidation and like they close down the company and they pay you some, the part that you know they cannot pay you because the person has gone to prison, suffered for it. That is the part that the law is actually allowing you to also deduct as a deductible expense. What are the reasonable steps we are talking about? A due process has been followed in respect of tax credit policy. All right. So the taxpayers credit policy. So it means that in the first place, you need to prove to us that you have the policy. You issued reminders for the person to collect your money. You also resorted to debt collecting agent, the factoring agent. You did debt reconstruction, settling of debt, all right, negotiation by court, all right. So that is that. Circumstances where debt can be considered bad. So when the debtor dies without leaving any assets for it to be recovered, debtor is bankrupt or in liquidation, there is no assets. The debt is statute bed or buried. All right. So I mean, I mean, so that is that. You can't do anything about it. When I say that, we are talking about the legal system. All right. If they declared it bad, it is bad. Okay. The data cannot be traced despite all attempts and all those things. Okay, so this one legally common sense applies. All right, so that is that. There are restrictions with regards to the banking sector. I mean, what we are doing is business. There is a whole tax concept for banking sectors. All right, so that is that. Over here, we are talking about specific. So section 88 provides that the Commissioner General shall allow bad debt in calculation of chargeable income where a person is conducting a banking business. I mean, these ones are very specific to the banking business and it follows the same trail anyway. So what happens is that specific provision for bad debts are in their act. All right. So if the debt was previously included in calculation of an income, and later the Commissioner General is certified that it is bad debt, I mean, that one is bad. So over here, it is not only just about the Commissioner General, you have to write to the Bank of Ghana, all right? So that is that. And then also the Commissioner General. And the due processes and everything also applies, all right? So that is that. You check whether there are collaterals and everything. In addition to above, the following condition must be met. Evidence of effort made to collect the money, whether due processes have been followed, the collateral provided are not encumbered, all right? Age analysis of the loan must be indicated. So all these things with respect to the banking thing. So a loan may be collateralized partially or not collateralized at all, fully, partially, and all. So we all know if the loan is on something is secured on an asset. So that is that. the bank have liquidated the security in settlement of the loan, and any write-off will be accepted. The balance will be accepted. So those are purely in terms of the banking sector. All right. So please, these are what you need to know. All right. In terms of our business income, these are what you need to know. All right. So what I would do is that please the date for recognition of bad debt, effective date is the date it has been approved by the Bank of Ghana. All right. Or before the due date for submission of ANA. So Bank of Ghana comes to play here in terms of the bank. Now, what I'm going to do is to pick a question in the past question. Let me see if I can get some. Business income is very easy. And just give you the signs because I need to run away. All right. I think so those in level 2, this is what I would say to end this class. Those in level 2, last sitting they had employment income. I think you guys should be prepared for business income or partnership income. All right, so what I'll let you do is to visit May 2021 and deal with question 3. All right, with all that we have said. Question 3. I think I'll have a separate Zoom class to deal with you in terms of solving the past questions, how to deal with that. Then when you go to then May 2020, also deal with question 3. Then yeah, I think 2022 August partnership came. 2022 December employment income came. So please be very, very careful. Let me see 2022 April. Okay, 2022 April, they had business income. So April 2022. So try your hands on it. Question 4 is there. So, if you're able to do this, it means you are prepared for business income. All right. Yeah, you are prepared for business income. Then let me see. 2020 November. That one, they had capital allowance and partnership. So, I mean, look through the past questions. Just start looking. Don't go to the exams without doing this, please. So check the past question from November 2019 to December 2022 for both levels. If you've not solved all these things, please don't go for the paper. I beg you. So please start downloading the past question and start dealing with that. All right. So that is business income. Thank you very much and have a great day. Before I go, so it is the P&L, the things you have to add back, you add back. All right, we've discussed all of them. So please, that is just a gist and a summary of everything. So have a great day. I'll see you